Welcome to part 2 of our reading on income taxes. Now, the first thing we're going to look at in part 2 is how to deal with a change in tax rate and how it affects our deferred tax assets and deferred tax liabilities. Now, as we know, deferred tax assets and deferred tax liabilities are based on temporary timing differences. That means differences that are expected to reverse in the future. Remember, with a deferred tax asset, we're paying more tax now, but we'll pay less when it reverses, hence we get an asset. And with a deferred tax liability, we're paying less tax now, but we'll pay more when it reverses. Now, what that actually means is when you create your deferred tax asset and deferred tax liability, theoretically, they should be created using the tax rate that you expect when the reversal occurs. Now, the problem is we don't know what the future tax rate will be. So chances are we're going to use today's tax rate when we create the deferred tax asset or liability. What that means is if the tax rate does change, we've created our asset or liability at the wrong tax rate and we'll need to make adjustments. So let's have a look at the impact of a change in tax rate. And I think this slide really is a great overview slide and will probably get you through most questions in the exam. If your tax rate decreases, then your deferred tax asset and deferred tax liability have been created at too high a rate. In other words, they're reversing at a lower rate. So we're going to need to reverse both the deferred tax liability and the deferred tax asset. Now, if you remember, when we saw an increase in a deferred tax liability, it increased the tax expense. Therefore, if we see a decrease in the deferred tax liability, that's going to decrease the tax expense. Now, flip side with our deferred tax asset, when we increase the deferred tax asset, it reduced the tax expense. So when we decrease the deferred tax asset, it's actually going to increase the income tax expense. When the tax rate increases, well, we're going to need to increase the deferred tax liability and increase the deferred tax asset. If we increase the deferred tax asset, it's going to increase the income tax expense. If we increase the deferred tax asset, it's going to decrease the income tax expense. So again, the key rule to remember here is increase the deferred tax liability, you increase the tax expense. Increase the deferred tax asset, you decrease a tax expense. And remember, our tax expense is made up of our three components: the tax payable plus any change in deferred tax liability minus any change in deferred tax asset. Now, of course, when we see a change in tax rate, the overall impact on the tax expense is going to depend on whether we have a net deferred tax asset or a net deferred tax liability. So in other words, it's going to depend on the relative sizes of the deferred tax liability and deferred tax asset. Let's put a few numbers behind this to try and make it a little bit clearer. So at the end of the year, a firm with a tax rate of 30% reports a deferred tax liability of 30 million and a deferred tax asset of 20 million. At the beginning of next year, the tax rate is increased to 35%. Okay, the important thing to note, therefore, is we've created our deferred tax asset and liability at a rate of 30%, but the tax rate has now increased. In other words, our deferred tax asset and liability are currently too low and we're going to need to increase them. When we increase the deferred tax liability, that's going to increase the tax expense. When we increase the deferred tax asset, that's going to decrease the tax expense. So let's have a look at what the rates or what the new asset and liability should be. So essentially all we've got to do is change the rate from 30 to 35%. You'll see that when we do that, our deferred tax liability is going to increase to 35 million. That's a 5 million increase in our deferred tax liability. Now, if our deferred tax liability is increased by 5 million, our tax expense is going to increase by 5 million as well. When we increase the deferred tax asset by up to 35%, notice it rises to 23.3 million. That's a 3.3 million increase in our deferred tax asset. Now, because the deferred tax asset's gone up by 3.3 million, the tax expense will go down by 3.3 million. Okay, so let's have a look at that income tax expense. You can see the net change in it is the increase in the deferred tax liability causes it to rise by 5 million. The increase in the deferred tax asset causes it to fall by 3.3 million. So overall, we've got a net 1.6 million increase in the tax expense caused by this change in tax rate. Now, of course, if the tax expense goes up, net income comes down. Okay, let's have a look at the deferred tax liability with a change in tax rate, therefore. Here we've got an asset that cost us $24,000 initially. It's got a 3-year life, and they're using straight line depreciation in the accounts and double declining depreciation in the tax returns. And we've been given a tax rate of 40%. And this time our tax rate is going to change to 35% at the end of year 2. So this time our deferred tax liability is going to shrink as a result of that change. Now notice what we've done here is we put in the tax depreciation. Remember, that's double declining balance, and it goes there, and our financial depreciation, which is a straight $8,000 straight line charge each year. We've also put in our tax base and our carrying value. Now if you remember, the tax base of an asset is the amounts that will go through future tax returns. Well, let's have a look at year 1. We've got a figure of 8,000, and you can see actually that figure of 8,000 is made up of 5,333 that will pass through the tax return in year 2, and 2,667 that will pass through the tax return in year 3. Notice the tax base in year 2 is 2,667, which of course simply relates to the remaining amount of 2,667 which will pass through in year 3. And of course in year 3 the tax base is 0 because no amounts are remaining to go through the tax returns. The carrying value, of course, of the asset in the accounts is the cost less the accumulated depreciation. So 24,000 less 8 gives us 16,000 in year 1. 24,000 less 2 lots of depreciation, so 24,000 less 16,000 gives us 8,000 in year 2. And of course, at the end of year 3, our asset is fully depreciated. Okay, so let's have a look at how we can work out that deferred tax liability. Notice what we're going to do is look at the difference between the balance sheet carrying value and the tax base. So let's take year 1. We've got a carrying value in the accounts of 16,000. We've got a tax base of 8,000. Take the carrying value, deduct the tax base to look at the difference. That's 8,000. Apply the tax rate of 40% to that, and we've got our deferred tax liability of 3,200. Let's do the same for year 2. Carrying value 8,000. Tax base 2,667, giving us a difference of 5,333. Notice though, of course, this time our tax rate is now 35%. If we take 35% of 5,333, we get our deferred tax liability of 1,867. And of course, in year 3, the carrying value is 0, the tax base is 0, giving us a difference of 0, and hence the deferred tax liability is 0. So notice, therefore, that at any point in time, our deferred tax liability is the carrying value in the balance sheet minus the tax base times the future tax rate. Okay, effects of tax rate changes. Well, the effect on taxes payable, this is the amount that we owe the tax authority. Well, if the tax rate goes up, we're going to end up paying them more on our profits, and if the tax rate goes down, we're going to end up paying less on our profits. So notice a decrease in future tax rates decreases tax payable and therefore increases future net income and hopefully operating cash flows. An increase in future tax rates, we're going to pay more tax, so it increases taxes payable, and of course we have lower net income and lower cash flow from operations. Now, the effect of a tax rate change overall is going to depend on whether we have a net deferred tax asset or a net deferred tax liability. So let's have a look at the first scenario that we've got on our slide here. In the first scenario, our deferred tax asset is greater than the deferred tax liability. In other words, we've got a net deferred tax asset. What that means is if the tax rate increases, that will increase this net asset. And of course, if it increases the net asset, it will reduce the income tax expense. Let's look at the other situation. The other situation we've got on the slide, the deferred tax asset is lower than the deferred tax liability. So we've got a net liability in this situation. So an increase in a tax rate this time will increase the net liability. And of course, that will increase the income tax expense. Now, our next LOS asks us to distinguish between permanent timing differences and temporary timing differences. A permanent difference is an item that will go through the tax returns in one period, but it will never go through the accounts, or alternatively, it will go through the accounts, but it will never go through the tax return. Remember temporary timing differences, and it's the temporary timing differences that cause your deferred tax. These, the same amount, will go through both the tax returns and the accounts, simply in different periods. Okay, so permanent differences. The key with permanent differences is to note they do not cause deferred tax. So they're not going to cause deferred tax. But what they will do is they will cause your effective rate and your statutory tax rate to differ. Now, the effective rate is, if you like, the rate that we are actually paying on our taxable profits in the accounts. So we take the income tax expense from the accounts over pre-tax income or profit before tax to get our effective tax rate. And notice when there are permanent differences around, that will no longer equal our statutory rate. Note, if you had temporary timing differences, then that does not cause the effective and the statutory tax rate to differ. The statutory tax rate is the rate that is applied from the tax code. So what are these permanent timing differences? Well, they could be tax-exempt income, so it's income that appears in the accounts, but it never goes through the tax return, or non-deductible expenses, so expenses that are going to appear in your financial statements, but are not allowed to appear in your tax returns. And we also might get tax credits for some kind of expenditure. Often capital expenditure may attract tax credits from the government. So let's have a look at our temporary differences at initial recognition. The carrying amount does not equal the tax base at initial recognition. Okay, so we're talking about a difference between the balance sheet amount and the tax base. Remember, the tax base being the amount that will go through future tax returns. Now, this situation where your carrying amount and your tax base are different at initial recognition are often caused by tax credits for capital expenditure. Okay, so in other words, I'm getting some tax benefit that I can offset against my capex. So you can see the company has received a government grant for an asset purchase. That reduces the carrying value, but it doesn't create a deferred tax asset. Now, business combinations. Now, no deferred tax on goodwill or goodwill impairments. Okay, there's a fact to learn, essentially. Deferred tax may arise on fair value adjustments of assets and liabilities acquired. When we acquire a subsidiary or a joint venture or an associate, what we're meant to do is take their balance sheet assets and adjust them from book values to fair values. And all we're simply saying here is that can lead to deferred tax implications. Now let's talk about the situation of subsidiaries, joint ventures and associates. Now we're talking in particular about the recognition of earnings versus dividends. Let's take the situation of a subsidiary. In the group accounts, you're going to record essentially the earnings of the subsidiary. Whereas in your tax return, typically we're going to see dividends. For joint ventures and associates, we bring in our share of its earnings. But again, for tax purposes, we just report the dividend that we've received. So there's a potential difference between what's going on in the accounts and what's going on in the tax returns. In the accounts, we're seeing the earnings of our subsidiaries, joint ventures and associates, and in the tax returns, we're seeing the dividends. Now, theoretically, that could cause us some timing differences. Now, assuming eventually all of the subsidiary, joint venture or associates profits are paid via way of a dividend, then we've got a temporary timing difference. So we are asked to record deferred tax liabilities unless the parent controls the timing of the reversal or timing differences are unlikely to reverse. Now, what would cause the timing difference to fail to reverse? Well, if those profits were never paid by way of a dividend from the subsidiary, joint venture or associate back to the parent. Okay, so there are potentially timing differences here. Now, our LOS asks us to describe the valuation allowance. We're asked, when is it required and its impact on the accounts? Now, valuation allowances appear under US GAAP and they relate to deferred tax assets. Now, remember the principle behind a deferred tax asset. When the deferred tax asset reverses, you're essentially going to pay less tax. Remember, DTAs are caused by paying more tax now, but less in the future. Now, what that does mean is when the deferred tax asset reverses, the company needs to be profitable. If the company is not profitable, it's not going to pay tax, so it's not going to benefit from the deferred tax assets reversal. So, US GAAP says if you think future profits in the company will be insufficient to benefit from its deferred tax assets, then we're going to reduce the deferred tax asset by a valuation allowance. IFRS takes a different approach. Rather than netting a valuation allowance against the deferred tax asset, it simply records a lower deferred tax asset. In other words, the deferred tax asset is shown after adjusting for the probability that the asset will be realized. Okay, so in other words, you shrink the deferred tax asset if you don't think you're going to be able to utilize it all under IFRS. Whereas under US GAAP, you record the full deferred tax asset and then you net a valuation allowance against it if you don't think you're going to be able to benefit from the full reversal. Now, of course, this valuation allowance can be used to manipulate income. Essentially, we can record a valuation allowance and then reverse it. Now, of course, when we record the valuation allowance, it's going to essentially decrease our net income. So when we reverse the valuation allowance, it will increase our net income. So essentially, by increasing and decreasing our valuation allowance, we can actually use it to help smooth our earnings. If you want to decrease your net income, simply increase the valuation allowance. If you want to decrease the if you want to increase the net income, simply decrease the valuation allowance. Now, as well we're saying on this slide, it may affect the analyst's assumptions regarding future earnings prospects and cash flows. If you spot a company with a valuation allowance, then that's that company saying, hey, we don't think our future profits are going to be sufficient to benefit from the reversal of our deferred tax assets. So immediately, as an analyst, I'd be thinking, hey, this is a big warning sign that future profitability may be lower. Now, our next LOS asks us to analyze the disclosures for deferred tax items. So notice we're going to need to show the changes in deferred tax liabilities by each source that caused the deferred tax liability. Okay. We're going to need to show the same for deferred tax assets. So we're going to need to show the change in deferred tax assets by each source, each category. And also notice in the footnotes we need to show any changes in the valuation allowance. So carrying on with our disclosures, note the items that need to be shown. The total deferred tax liability or asset, okay, any valuation allowances, and of course the changes in the valuation allowances. We need to show any unrecognized deferred tax liabilities for undistributed earnings of subsidiaries and joint ventures. Now, what does that phrase mean? The unrecognized deferred tax liability for undistributed earnings of subsidiaries and joint ventures. Remember, in the accounts, we're showing for a subsidiary its earnings. In the tax returns, we're showing its dividends. So unless that subsidiary pays all of its earnings by way of a dividend, there's an undistributed element. Current year tax effects of each temporary difference. So we need to show the current impact of each temporary difference and how it affects the tax expense. We need to show the components of the income tax expense, any tax loss carry forwards and credits. Remember, tax loss carry forwards, if you have taxable losses, rather than the tax authorities paying you, you get to essentially keep those tax losses and offset them against future taxable gains. Notice as well we need to show a reconciliation of the difference between the tax expense as a percentage of pre-tax income and statutory tax rate. Now, of course, when we look at the difference between the tax expense and the statutory tax rate as a percentage, so the effective tax rate and the statutory tax rate, we're going to see all of the permanent timing differences showing up. We'll also see differences caused by paying different taxes at different rates in different tax jurisdictions, especially if we're a multinational company. The analysis of deferred tax disclosures, well, look, be aware of differences in the tax reconciliation between periods, in particular the reconciliation of effective and statutory tax rates. Look for cumulative differences due to asset impairments and post-retirement benefits. Yeah, again, post-retirement benefits do kick up essentially some deferred tax issues, essentially, especially with defined benefit pensions. What you see is the amount going through the income tax, the amount going through the financial statements is not the same as the amount that goes through the tax returns. The amount that goes through the tax returns is the employer's contribution. So again, you get deferred tax, normally deferred tax assets as a result of post-retirement benefit schemes, defined benefit pension accounts. Asset impairments. Well, again, with an asset impairment, it's certainly going to have a dramatic impact on the carrying value of the asset in the balance sheet. However, that impairment does not go through the tax returns. Impairments are not going to go through the tax returns. They're not going to save you tax. Otherwise, companies could simply impair assets to reduce their tax bill. So again, there's implications for deferred tax here in terms of timing differences. Restructuring charges is another one. Now, we account for restructuring charges as soon as the restructuring is announced, whereas the restructuring charge goes through the tax return when it's actually incurred or expensed, and those two dates, of course, may differ. Now, our last little LOS here asks us to identify the key differences between IFRS and US GAAP. Well, IFRS, of course, we can revalue our PP&E and intangibles. Now, when we revalue PP&E and intangibles, the unrealized gain goes direct to equity. Now, of course, this also changes the carrying value of the asset. So does it have an impact on the deferred tax liability? Certainly, revaluation to fair value is going to have an impact on future tax paid when we dispose of the asset, because we're saying the value of this asset is higher and hence we will be paying more tax. But we don't increase our deferred tax liability. Instead, we net the additional tax against the revaluation, the unrealized gain sitting in stockholders' equity. Undistributed profits from subsidiaries, associates and joint ventures again slightly differs. US GAAP uses its indefinite reversal criteria and typically doesn't create deferred tax assets and liabilities as a result. IFRS says a deferred tax liability or asset should be created unless the parent controls the distribution of profits and it is probable that the difference will not reverse in the future. Now notice as well with our deferred tax assets, IFRS says we recognize if recovery is probable. Okay, now of course that has the implication with deferred tax assets that if you think future profitability will be insufficient to benefit from the whole asset, then we only report the amount that we'll be able to utilize in the balance sheet. Whereas US GAAP, different approach. Remember, they show the full deferred tax asset and then they net a valuation allowance against it if they're not going to be able to utilize the full deferred tax asset due to lack of future profitability. Presentation slightly differs as well. US GAAP requires us to split our deferred tax liabilities between current and non-current. So current would include the deferred tax liability amount that reverses in the next period. Non-current would be the deferred tax liability that reverses after more than one period. IFRS, we treat all deferred tax as non-current.